Welcome to the first of our roundtable discussions with members of the profession. This is the first of a number we'll do throughout the modules. So today we're going to look at the Module 2 topic being defining insolvency. With me today is Jeanette Muller, a registered liquidator, and Claire Burney, also a registered liquidator. So we're going to have a chat about what insolvency really means, being obviously that's at the heart of any insolvency practitioner's work day to day. All right, so the Corporations Law and the Bankruptcy Act basically share the same definition for insolvency. The kind of the reverse definition. They basically define insolvency, then say if you're not solvent, you must be insolvent. So from your practical experience, what do you think insolvency actually means, Jeanette?
Okay, well, I'd say it's an inability to pay your debts as and when they fall due. So in its simplest forms, can you pay this debt which is due today? An inability to do that would imply that one is insolvent.
So a person in business, it's pretty obvious. There's obviously got to be some flexibility around that to some extent.
Yeah, well then, of course, you then look at, okay, well what available resources do you have in addition to the company's resources? Can you borrow money? Are there some assets you can sell? Taking into account all of the circumstances that you have. Do you have the ability to enter into some repayment arrangements? In which case, if you did, then you'd say that, well, that debt's not actually due. So if I enter into an arrangement with you and we break up the debt that's actually due today, well, it's not due then.
Yeah, okay. So you can say there's no real hard line. It's more a curvy line or possibly even a grey line. But at some point, the owner of the business or the bankrupt has to basically make a decision, I am insolvent.
Yes, it's a zone and it's less obvious to the person who's operating the business when it actually occurs. We, of course, as liquidators and bankruptcy trustees will then go back over and forensically examine all the circumstances that were present at particular times to effectively establish a date when the company or the person was in effect insolvent.
So Claire, that actually becomes important, doesn't it? Because a lot of things would focused around that date.
Yeah, so you've got to look at whether you can't pay your debts today, and then look at can you pay your debts tomorrow. And it's companies make losses, but have an expectation that upon a sale of an asset or receiving debtor monies, that insolvency will turn into a profit next month. So continued losses are something that needs to be highlighted. In addition to, what like Jeanette said before, what are the access to other resources to pay down that debt? Is it a short-term problem or a long-term problem?
So the courts talk about the cash flow test and the asset test, and obviously they're more interested in the cash flow test, to be brutally honest. So therefore, we're not merely looking at the cash flow of the company, we're also looking at its ability to arrange or raise other funds from asset sales or whatever to fund its operations. Is that right?
Yeah. It's effectively, if it can't pay its debt when it's full due, does it have any resources available to it to pay down those liabilities?
So is there really a difference, albeit the two acts use the same definition, is there really a difference between a corporate insolvent, when a corporate's insolvent compared to when a personal debt is insolvent? It's roughly the same.
Well, not much at all.
I guess the difference there is that a person doesn't necessarily have accounts. They don't, a person doesn't have a ledger that they keep an accounting record in a debit and credit scenario. Their bank statement is usually it in terms of records. Whereas accounting in a corporate sense, obviously there's accounting principles can be applied. There's ways of doing accounts. There's a lot more involved in a insolvency of a company in the sense that there's a lot more paperwork. Whereas in a personal bankruptcy, it's literally the records are bank statements and tax returns.
Yeah.
I suppose the question is, why are you assessing the date of insolvency and why is it important from a liquidator's point of view or a bankruptcy trustee's point of view? So from a liquidator's point of view, the reason it's important is because a lot of the legislation or the recovery procedures that we go through pivot around this date of insolvency. So for example, if you're seeking to recover preferences or a lot of the compensation claims that you might lodge, for example, insolvent trading, etc., around 588 the Corporations Act, you need to look at those all of those sections with the view of when did the company become insolvent, because that's your step number one. most of them have to be insolvent transactions, and so the first step is to work out the date of insolvency and then go from there.
Yeah, so that's why it becomes important. So just on recent times, just looking at the corporate insolvency, could you put your finger on what the primary causes of corporate insolvency are of late? And kind of comment on whether they've changed over the last 10 years at all?
I think businesses' access to credit funds has definitely been restricted in the short term.
So the tightening of the credit market?
Most definitely. And, I think there's been a number of industries that have been hit very hard in the last little while. Manufacturing and retail are ones that come up a lot. And, they have a broader impact on the economy. And where consumers can spend money, where they can engage with other businesses. And in terms of, has it changed in the last 10 years? Somewhat, but not really. You still see the same reasons as to why people are insolvent.
It seems that the retail market is doing it pretty hard at the moment. I noticed this morning a large natural food chain has just gone to voluntary administration. So is that what you're seeing in the marketplace at the moment? It's becoming maybe the gig economy with all the internet buying, etc. It becomes more difficult?
We're a stakeholder. A business is a stakeholder within the larger community. So if consumer spending is down, it flows right down to small business, medium business, large business. There's all the stakeholders involved. There's the employees, there's suppliers, there's landlords, and every one of these people at any time are reliant on certain things happening that affect their insolvency or solvency of their business.
Yeah, but certainly, businesses need to be alive to the fact that there's disruption going on constantly. There's competition. Probably can't ignore that we're a very regulated economy as well, and it's not everyone's cut out to be a business operator, and so you do see on average anywhere from 9,000 to 10,000 odd businesses going into liquidation, certainly insolvencies per annum. But just as many start up as well. So it's a bit of a mix as to the reasons for any business going into liquidation vary depending on industries, depending on, you might see a lot of mining. If there's a closure of a mine in a particular area, then all those service industries might suffer, etc. The drought, I'm sure that's having an impact on the suppliers to that industry as well. So, very varying reasons for insolvency.
So one of the areas, and this wasn't on your talking point, so I apologise, I'm just going to drop it on the table. One of the areas that now the new legislation that's been coming through over the last couple of years provide is this concept of safe harbour. And I know you have an interest in that, Jeanette, so could you explain to our viewers what safe harbour is and how it's affecting the insolvency decision?
Sure. So safe harbour is a protection that directors can engage with. It effectively gives them protection from insolvent trading. So, for example, we talked earlier about not knowing precisely when you might become insolvent. So that allows the directors to basically prepare themselves in case they become insolvent. And what they might be facing is some uncertainty in their industry or some uncertainty in relation to their business or perhaps a litigation against them. And so they're not in trouble right now, but they can see some problems ahead for whatever reason that might be. And so, and they might be, feeling that there's some changes that need to be done with respect to their business. So they might decide to pull in someone like myself, an appropriately qualified entity, and provide me with a turnaround plan that they've prepared. And they can then implement that plan with the protection that if it goes wrong or if they don't succeed, and unfortunately somewhere down the track they end up being placed into liquidation, that from the moment they went into the safe harbour to the moment that the liquidation commenced, they won't be held liable for that period for insolvent trading. Now, if they've been insolvent prior to the date of accessing safe harbour, they could still be liable for insolvent trading for that pre-period, but certainly from the time that they take advantage of the safe harbour provisions, then they should be fine with respect to avoiding any insolvent trading. And in order to qualify for safe harbour, they would need to have paid all their employee entitlements. They would need to have made sure that they've lodged all their BASs and any other statutory tax type payments, not payments but lodgements, and have their turnaround plan. And their turnaround plan, of course, it's called a better outcome plan in fact, that needs to envisage a better outcome than what would be expected if the company was placed into external administration. So usually that's fairly straightforward. As you can imagine, if you place a company into external administration, immediately it crystallises a lot of liabilities, etc., including employee entitlements. So the option of continuing to trade is usually quite a positive one for companies if they've got a realistic plan that can work.
So this is in line to some extent with the kind of the change in the insolvency industry over the last few years, where they're being more proactive prior to any action happening, the kind of the reconstruction or the turnaround type stuff.
Correct. It's trying to encourage directors to take matters into their own hands and not suddenly reach a point where they believe the company's insolvent or about to become insolvent, and then the fear of potentially breaching directors' duties by insolvent trading. So it's sort of like, okay, the government recognises that there's that danger zone for directors. It's part of their, what they said, the reasons for introducing it is that, okay, so take a risk, take a reasonable risk, and you'll be protected.
Yep, okay.
Because not all causes of insolvency have a malicious vein to it. Sometimes bad luck. You might lose a major customer, something might happen, and the cause of the insolvency of the business isn't fundamentally meaning that the business has done anything wrong.
Well, we'll look at safe harbour, I think, and when we get to Module 10 specifically, Module 10 is going to be a kind of a moving feast to some extent throughout the course, and it will deal with any current issues in insolvency. All right, so that's our round table for Module 2, Insolvency. We'll see you again in the next module where we deal with voluntary administration.